All right. Today is Thursday, the 11th of May. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. And let's begin with this. Thank you to all of the members that joined recently. For those who joined in the Top Gun Maverick tier, I'm going to update the credits to include the newest names who joined us recently. And of course, if you go to my channel, to the community tab, if you want to change your name in the credits, just let me know. I know a lot of you use the membership as a tax write-off for your business. So if you want your business name to be there, just in case these IRS folks try to make some trouble, you can show them, hey, look, the name is right there in the credits. This is a business expense. And of course, if you want to join our Discord, you got the little tab there. If you go to my channel, and over the weekend, we're going to have new updates on Discord. There's going to be a channel with the instructions on how to join, how to integrate, all of that. So nobody's going to be left behind. No more, hey Maverick, I'm not in. Here's my username. No. We're going to take care of everything right there. And we're going to have more improvements coming. And of course, we're going to have more read-only channels for the first class tier too. Lots of improvements coming. I just have to catch up on some videos this week, and then next week I'm going to be working more in Discord and improving the engagement on the platform. Now, today was not very active on Discord, but tomorrow I'm gonna be. And perhaps we're gonna have more action in the stock market, and the reason is we're gonna be heading into the weekend. And so far, for the majority of the year, the Friday before the weekend, we see de-risking, not by selling stocks, but by short covering and crushing the VIX. And the reason is the risk has been to the upside so far. But now we have this debt ceiling negotiation, and so far we've been dismissing the problem and saying, okay, they're not gonna let the country default. They're going to get together and make a deal at some point, so I don't have to worry about it right now. I don't have to dump my stocks. I don't have to hedge. We're seeing some hedging in the credit market, but we're not seeing any hedging in the stock market via buying puts or buying the VIX or selling stocks, because the consensus has been, oh, it's going to get resolved. But as we head closer to June 1st, and we don't have a resolution yet, we're going to start to panic. We're going to start to feel that maybe this is going to go in a direction that we did not really anticipate ahead of time. And all of a sudden comes the stampeding in hedging. And this major shift in sentiment could be starting as soon as tomorrow. Heading into the weekend, we don't know what's going to happen. We got some bad news here. The media is trying to spin this into a good thing. Oh, they're taking a break. They're delaying the negotiations that were supposed to happen tomorrow. And that's a good thing because it means they're close to making a deal. I don't believe any of that. I think we have a problem here. We're running out of time. They're supposed to be sitting down tomorrow and coming up with a plan. If they're not sitting down tomorrow, we got about 2 weeks left here, and we're running out of time. And I understand that we have a different process of thinking this time around versus 2011. Back in the day, it was a different generation of investors. And the way we got desirable outcomes from the federal government or the Federal Reserve was by crashing the market. In 2011, for example, the managers were passing a note saying sell, crash the stock market so we can get a deal. And we can scoop up a lot of these assets at a cheaper value. And we did the same thing in 2009, crashing the market to get a reaction from the federal government to pass the bailouts. But now we have a new generation of investors who thinks differently, who says, oh, the debt ceiling negotiation, don't worry about that. They're not going to let the country default, and we have to buy in anticipation of the deal. Or the Fed is going to pivot at some point. We have to buy ahead of time in anticipation of that. It is an entirely different process of thinking. It is an entirely different generation of investors. Will they do the same this time around if it comes to the 11th hour in the debt ceiling negotiation? I doubt it, but you got to remember, a huge amount of the money in the stock market right now is managed by the same managers who were alive and active back in 2011. And they're going to follow the same playbook at some point, that to get the federal government to come up with a desirable outcome when it comes to this debt ceiling negotiation, we have to crash the stock market to force them to chop, get it together, get a deal done. And I think we're getting closer to that. Absent, of course, if we get breaking news tomorrow and all of a sudden, oh, Biden or McCarthy decided to capitulate, which I don't see happening right now. I think we need to turn up the heat a little more. Number one, running out of time. Number two, a negative reaction in the stock market. And immediately somebody's going to capitulate. But absent of that, this could drag on. And then we start to panic at the last minute. Oh my God, we're going to default. We have to sell now. We have to hedge now. And the cost will be a lot higher. So I'm just telling you right now from what I'm hearing, the managers are getting a little panicky at the moment right now. And they might start taking action as soon as tomorrow, before the weekend. We'll see what happens, but this is something you gotta keep in mind. Even Jamie Dimon came out today warning that, hey, panic might overtake markets as the US approaches the debt default. We're going to talk about the comments by Dimon in the In Focus segment on the public channel tonight. But again, when he comes out and says these kind of things, I don't know how familiar you are with Jamie Dimon's reputation in Wall Street, but he's a telltale. He talks a lot. He says things he's not supposed to say. You tell him something in secret, he comes out and tell it to everybody. And then he backtracks and says, oh, no. I didn't mean that. So he talked about the hurricane coming, and then when people gave him a lot of heat about it, he came out to clean up that job. And then he said the banking crisis is not over. The worst is yet to come. Then they gave him a lot of heat about this. He came back and he cleaned all of that comment by saying, oh, the majority, the biggest part of the crisis is over. And next thing you know, First Republic Bank is blowing up. And now we have PacWest might blow up anytime soon. So now when he comes out and says, watch out, panic might overtake markets, he's hearing things. The managers are telling him a lot of things. He's seeing the flows, the plans that are about to happen. So he comes out and he says it. Then the market panics. He gets a lot of heat. He has to come out and clean it up. Oh, our country's never going to default. That's never going to happen. But anyways, we'll talk about him in details in the In Focus segment. What do we got today? In the morning, we got the PPI, and again, almost meeting expectations, but it is way weaker than the CPI. This is the smallest increase since 2021. Of course, the month-over-month reading was up. So again, we have points for the bulls, we have points for the bears, but you gotta understand that the bears are split in two camps now. There's the camp that says the risk of inflation is still here. There's another camp that would look at this kind of information and says, watch out, the PPI is pointing out for a recession. And this kind of data, you'd think it would excite the soft landing camp, who's been betting that inflation is going to go down, the economy is going to stay intact, and the Fed will back off into the story. But then they get what they wanted, and the PPI shows that inflation is getting crushed, at least in the producer side, all the way almost close to the target of 2%. And they're not happy about it, because now they're getting nervous about, oh my God, could this be because of an upcoming recession? And this is the kind of confusion we have to deal with pretty much every single day now, folks. Then we got the news from China overnight. Inflation is down almost to zero, the slowest pace in 2 years. So again, the bulls are getting what they wanted. Inflation is going down, but maybe it is going down for the wrong reasons. And this is making markets really nervous right now. You add to all of this dynamic of, oh, maybe inflation is going down in China in the producer's side because of an upcoming recession. But on the other hand, rates are still too high, meaning the risk of bank failures and more entities blowing up, not just banks. We're talking about real estate, we're talking about zombie companies, and many more. The risk is still too high so long as rates are not being cut aggressively. But there's a problem. And the problem is maybe we're seeing some weakness in the US economy that prompts a pause, not a cut, but a pause. On the other hand, across the Atlantic, you heard what I showed you last night from the ECB, and today I'm going to show you in the In Focus segment what took place in the Bank of England today. The BOE is way behind the curve right now. If the Fed pauses or cuts rates right now, it's going to mess up the job for the BOE, for the ECB too, because both of them are still way behind the curve. And this is a massive dilemma that nobody's paying attention to right now. That even if the Fed wants to pause, even if the data prompt them to pause, it's really hard to do because all of these central banks have to be in synchrony. That's number one. Number two, the market is looking for cuts, not a pause. A pause is not enough. Perhaps the most alarming thing, if you ask me what keeps you up at night, what keeps me up at night is, what if the Fed is too late to that pause, if we play the devil's advocate? And that would be the case only if the unemployment rate is actually in real life, is moving higher, not lower, meaning the cooks at the bureau are lying, or they're having lagged data. If the unemployment rate is moving higher, significantly so in real life, then the Fed is now late to the game in the pause. They've always pivoted the moment they saw the unemployment rate rising higher, and we see negative job creation in the economy. But what if the data is lying? What if the data is wrong? We get these massive revisions from the BLS every single time. What if they got it wrong? And in reality, the unemployment picture is not really that rosy. The problem is we have the icy hot kind of economy. Anecdotally, I can say, look, I own a bar. I started a healthcare business this year. And I can tell you, I can't find employees. No matter how high I pay, I can't find employees. So there is a legitimate shortage of labor in certain sectors. If you're in the airline industry, the same thing is happening. But then you look at other industries and you see a cold economy where layoffs are actually happening, where people are losing jobs every single day. Now, what do you make with all of this? Today we got jobless claims with massive spike jumping to 264,000 from 242,000 in the prior week. That is a big jump in 1 week. So again, what if we're seeing the unemployment rate actually rising higher? If you recall, I told you in this program that the number one enemy for inflation is unemployment. You want to crush inflation out of the economy? Spike the unemployment rate higher. What if it's already moving higher, but the Bureau is lying and giving us false data? That is something that should be really alarming to everybody. We have some indicators here that say, watch out, there's massive slowdown happening in the economy, and it comes from commodities. We talked about the icy hot economy. You look at sugar futures, for example, cocoa futures, those are blasting higher. Then you look at old school commodities that have been reliable indicators of the economy and the stock market for years, for decades. The likes of copper, for example. And copper is not saying good things about the economy. Copper tracks the stock market. Copper predicts the upcoming expansion in the economy. It bottoms usually before the stock market. And we see somewhat of a correlation between copper and the stock market because copper is cyclical. Copper appreciates in value in good times, depreciates in bad ones. This time, if you look at the chart right here, in white, copper futures, in orange, the S&P 500. Right now, we're seeing a massive divergence. Copper is crashing, the S&P is holding. And we can argue this is because of the AI mania and the big cap technology names. Warranted, but there is a massive divergence here. And we've seen those happening before. The latest back in the fake bear market rally last summer. Copper was going down, equities were going higher, and we know who was telling the truth in that one. Likewise, late 21, copper was crashing down, equities moving higher. You see the gap. Who was telling the truth back then? The answer is copper. And of course, copper caught a spike because of the Russia-Ukraine invasion, but then it came down. In late 22, in early 23, copper rebounded and moved higher. And the basis of that was the China reopening. And with it, equities also moved higher. But now we're starting to learn that the China reopening is overhyped and copper is diving down. The question is, when will the equities market catch up with this? Because we know that copper is the one telling the truth. And the same goes for the NASDAQ, by the way. This is the NASDAQ in orange this time around, copper still in white. You can see the divergence. Q's moving higher, copper moving down. And we've seen these kind of divergences before. And copper was the one telling the truth. So again, folks, we get accused a lot of being perma-bears or being doom and gloom, but what do you want me to do when I see this kind of data? Do I just come out and tell you that everything is okay? I'm not saying go ahead and short everything right now. All I'm saying is we have really alarming signs going on, and we should not be surprised if things turn sour really quickly, rapidly, in a rug pull way. It was a baffling action that we got today. Just look at what happened to silver, for example. That thing crashed. The cyclical side of the stock market was down, so you'd think we have a recession theme, but in a recession theme, shouldn't gold and silver appreciate? No. Silver was crashing, gold was flattish, and the only action that we got today is led by a handful of names. Amazon, Google, Tesla, and some Chinese stocks. That's all there is. And bad breadth is also a leading indicator that this is not a healthy rally. Yet another sign we've been ignoring for a long time now. Anyhow, folks, we'll talk about this and a lot more, but we have to move on and cover the market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average down by 221.82 points, or a decline of 0.66%. The Nasdaq in the green by 22.06 points, or a gain of 0.18%. The S&P negative by 7.02 points, or a decline of 0.17%. When we look at the sectors, down for the most part, with exception of communication services, aka Google, and then you got consumer cyclicals, aka Amazon. Besides that, pretty much everything was down. When we look at the breadth, it is awful. NYSE 29% advancing versus 70% declining. The Nasdaq 33% advancing versus 64% declining. But again, the Nasdaq closed positive. Thank you to just one name, Google. And all what they have to do is just keep the rest of big caps flattish, Apple, Microsoft, Meta, and then rally one or two names. And they shuffle from Google and Amazon one week, then Meta and Microsoft the other, and then another week Apple, lather, rinse, repeat, and the market holds. How long will this game keep going? Somebody said AI this week. Oh, let's go ahead and stampede and push that one up. Anyways, commodities, futures, what do we see here? Crash across the board. It was a bloodbath, led by, of course, metals, while gold held a lot better, down about 1%. Silver was down over 5%. Copper down over 3.5%. Palladium down over 3%. Platinum down almost 1.5%. Energy did not do pretty good either. WTI down about 1.5%. Brent down about 1.25%. Gasoline down about 1%. Heating oil down about 1.5%. But holding flat, natural gas, and that's a win for nat gas bulls, considering the fact that commodities are crashing. When we look at softs, more weakness for coffee, lumber down a little bit, cotton down about a little over 1.25%, OJ rebound, be it flattish, and then you got the recent runners in cocoa and sugar. They're pulling back, sugar down about 2.25%, cocoa down a little over 0.5 percentage point, but again, the rally is huge, and these are just mere pullbacks. Flattish activities in meats. On the other hand, grains down across the board, whether we're talking about wheat, corn, they're both down more than 2%. And the only winner that we got today is soybean meal with a rebound of about 3% for the day. The dollar was up, and this is perhaps in relation to the debt ceiling, but we can see that the pop in the dollar came at the expense of the euro, the British pound, the Canadian dollar, the Kiwi, the Aussie, all down for the day. Even though the BOE raised rates by 25 basis points and they're not done. Yet we saw a stampede on the dollar today. My hunch is because of the debt ceiling. So it is a confusing theme. If you say it's a recession theme, then explain to me why gold is not performing today. Or silver. So I believe we're starting to see some fears about a recession, that China is slowing down, hence oil is down, metals are down, copper specifically. But then we also have the other fear, the collision, they're colliding with each other, the debt ceiling and the recession fear, and we see the dollar going higher. And that added a lot of pressure on commodities today. It's a double whammy, and hence we see gold and silver down along with the rest of them. On to the big casino, the options market. What do we see here? The volume is back up again, and we see a stampede in buying certain call options in certain names. Can we say this is retail investors? I have my doubts about that. I think these are professional firms. They're looking at the IV rank. They have their sophisticated programs. They see where the market maker is underweight. They see the potential for a gamma squeeze, and they start buying these call options to push certain stocks higher. And today was a clear example of that. At number one, per usual, the hottest table by far, Tesla. And we have some news about Tesla on Twitter. We'll talk about that in a minute, but about 1.8 million contracts traded today, about 62% of those were calls. Apple at number two, with about 1.3 million contracts traded today, about 71% of the volume was calls. This is quite unusual. It smells to me as the professionals want to keep the market intact by pumping these names using call options. You're not going to see Apple trading 71% of the volume as calls. That's not usual. And then at number three, we got Alphabet, Google, with about 1.2 million contracts traded today, about 60% of those were calls. And I don't know if you saw my midday brief or not. We have to talk about this because we have options expiration tomorrow, not the big one, but the weekly ones. And we have to look at Max Payne. We have a handful of names moving markets right now, so we have to see what the market maker is looking at. And when it comes to Apple, as I said, it is at the sweet spot right now. The majority of calls are above 175. The majority of puts are below 172.5. So if the market maker parks Apple at 173, 174, that would be a good Max Payne point. Of course, you always have to be mindful of the risk. If we have bad reaction due to the debt ceiling, for example, and we see folks dumping Apple, and it moves closer to 172.5, then the puts start to be activated, the market maker will be forced to have a gamma squeeze, this time around to the downside, also known as a reverse gamma squeeze, because they have to sell now, let's say at 172.5 to cover for the 170s, 168, 165 puts. And we see a big flush down. That is a possibility, not the consensus though. When it comes to Amazon, it has been under a gamma squeeze, and the target was at around 112. This is the contract with the highest volume and the highest open interest. We got there today, and I'll show you in the charts that these traders are looking exactly at the chart I'm looking at. So it's not arbitrary. And on top of that, the IV rank in Amazon was close to zero, really easy to induce a gamma squeeze. They took advantage of that. The beauty for the market maker is a lot of calls are now in the money, but they got 1 day left. And nobody's buying puts on Amazon. The closest contracts with relatively high volume and open interest is the 108. So theoretically, if the market maker wants to induce Max Payne on all of these call buyers, they got the room to push Amazon all the way down to 108. Are they going to do that? Are we going to see Amazon crashing tomorrow? Not necessarily, because we have the bigger weekly expiration, the monthly expiration, coming out next week. They have to be mindful of that, not to push Amazon down too much. So you might see them, the market maker that is, saying, okay, let's induce some pain on the 112, 111, maybe 110 call holders. We close Amazon at 109.5, 110 exactly. It doesn't matter what number they choose. The point being is they got plenty of room to move to the downside to make a lot of calls expire out of the money tomorrow. When it comes to Microsoft, the spread is really wide. The real threat for the market maker is 315 on the upside, 300 to the downside. So for now, Microsoft is exactly at the sweetest spot, but again, it all depends on what's going to happen tomorrow. If we have a stampede of buying all of a sudden in Microsoft, you can see the market maker getting squeezed all the way to 315. If we have a sell-off scenario, we can see the market maker getting squeezed all the way down to 300. So what do you do with that kind of information as a trader? Let's say we have a panicky day tomorrow, as an example, and you see Microsoft moving closer to 300. It has to be a safe assumption that it will be pushed down all the way closer to 300. So as a trader, that will be the contract you choose to play, the 300 puts. Whether you choose the same expiration date or next week, but that would be the contract you choose as a strike. And you get in, you score quick profits, you get out, you know the deal. And lastly, Meta, it has been dormant for the week, no activities at all. The highest open interest at 240, we're not close to that. There is no risk here that the market maker will be squeezed all the way to 240. In all likelihood, actually, we might see a crack below 230. We'll talk about that in the charts analysis. On to the unusual activities that took place in the options market today. We'll begin with the ticker TWLO Twilio. The name crashed after earnings, and somebody's bidding for more pain to come. They bought the 42 puts for the expiration date, July 21st, with the expectations that Twilio will go down and lose more than 11.5% of its value by then. They paid about $2 a piece to enter this trade, all in all spending around $720,000. And then we have the ticker WYNN for Wynn Resorts. I thought it was a good earnings report. I go to Vegas a lot. I'm always at the Wynn, and every time I go there, it's packed, and they say that the rooms are fully booked even though it's a Tuesday. So business has been hot, at least in Vegas. I don't know what's going on in Macau, but again, in this case, the stock rallied higher ahead of the print. So even though the print was good, we see a disappointing reaction. It's somebody's bidding for a rebound here, and they bought the 115 calls for the expiration date, July 21st, with the expectations that the name will rebound and gain more than 8% by then. They paid about $3.40 a piece to enter this trade, all in all spending around $1.2 million. Now honestly, I'd rather play PENN, Penn National. The results were pretty good. The company is in trouble for reasons that are not related to earnings right now, but it's holding support. I'm watching it, keeping an eye. Maybe it's going to be a good call options play. So keep the chart of PENN in your radar. It might play out. Last but not least, we got the ticker SRPT for Sarepta Therapeutics. Massive amount of activities going on in this name. The stock is down because they have a new therapy that the FDA is doubtful about, but there is a big decision coming. Rumors are flying all over the place that they might get an approval or a rejection coming really soon. And again, the insiders, they're buying calls, they're buying puts, they're doing a lot of funny business here. And the premiums are really, really high. So I'll show you this trade right here. It's a call options trade, but it could be a holder of the stock riding these calls. Because why not? You can raise an insane amount of money if you own the stock. But we have to read it from the buyer's perspective. But I'm confident that this is a covered call trade. Anyhow, somebody bought the 130 calls for the expiration date, May 19th, with the expectations that SRPT will pop higher and gain more than 8% by the expiration date. And they paid about $15 a piece to enter this trade, all in all spending around $5 million. Now, why do we say that this is likely to be a covered call? Number one, it's a $5 million trade. Number two, it expires in 8 days. So even if you want to bet on SRPT to pop significantly higher, you're not going to spend and risk $5 million for 8 days, unless of course you're not rational. So this is likely to be a covered call, somebody raising cash rather than betting for an upside coming for this name. Moving on to the heat map analysis, what do we see here? A bloodbath across the board, metals getting crushed, regional banks getting crushed, energy getting crushed, real estate, utilities, industrial, healthcare. The majority of cyclicals are down. The majority of tech is down. Chips down, software down. The exception being the big caps, Apple, but mostly Google, Amazon, Meta, and Tesla caught a bid by the end of the day because of the news we're going to cover in a minute. But you got the Chinese names. Those are up to Alibaba, JD, and I believe this is due to JD's earnings. And then you got Netflix caught a bid, and the reason is Disney bombed. Disney lost a lot of subscribers. 4 million subscribers for Disney Plus gone. And it shows you how tough the streaming business is. It is Darwinism, survival for the fittest, and of course, Netflix has the leadership advantage. So you got Paramount, that's blowing up. Warner Brothers blew up. Now Disney blowing up, down over 8% in a single day. They're having a hard time catching up with Netflix. They need a new plan. I have the answer. The question is, will Bob Iger listen? Will the folks at Paramount and Discovery and all of these companies listen? Of course not. So who gives a shit about them? And this is why Netflix caught a bid. Disney was down. And of course, we know that Disney's war with Governor DeSantis in Florida. That's another mess. We can talk about that in another video. But among the names that blew up today, Peloton down about what, 8-10% today? And this is due to a recall, a big one. 2 million bikes due to faulty seats. Folks, it's an overpriced bike with cheap shit made in China, and you just slap in an iPad and they call this a revolution. Give me a break. The winners, on the other hand, Google, and in a nutshell, the reason is they said AI, and boom, the stock goes higher. They revealed a bunch of new shit, the Pixel, the new flip phone, that has been a disaster from the get-go. Now they want to charge $1,800 for the phone. Give me a break. Why would I pay that for a shitty phone? And of course, for the most part, they said AI, and that does the job. But among the winners, again, Tesla, we talked about that, and the reason is Elon Musk now says he's stepping down as Twitter CEO, and he has a female CEO in mind who will take his place. We have yet to know the identity of this female CEO, but the thinking goes if Elon is not occupied with Twitter, he'll have more time for Tesla. The problem is Tesla's problems are not Elon related. Tesla's problems are market related, the economics. There's a price war, competition is rising, the input cost versus the demand. These are things that Elon cannot really solve. These are economics related. These are related to the accountants, the managers, the engineers to deal with, not for Elon. Elon's role in Tesla, I believe, is over. The company needed a visionary back then, but now it needs a tough manager who understands margins and can improve the margins of the company. So I think this is not related. This is just a move because, Elon might be more available for Tesla, I guess, and folks are buying, and this could cause a short covering Friday for Tesla tomorrow. We'll see what happens. But for now, we're moving on to the heat map for the ETFs, and again, a bloodbath across the board. Not a severe one, though. The KRE, this is the sick child of the stock market. It continues to go down. Today, it's down yet again by about 2.5%, excuse me. And now we have, alarmingly, the XME. Metals are down about 3%. Energy down. Gold, the GDX crashing today, down over 4%. SLV silver crashing, down about 5%. The majority of international markets are down. So we have what it appears to be a recession theme. But then explain to me why utilities are down, why real estate is down if yields are moving down, and why gold is getting crushed. I believe today was de-risking because of the debt ceiling, because of the recession prospects. So we saw exodus from all corners, the exception being the large cap growth due to Google, and this is happening because of an AI mania and options market activities. But keep an eye on the XBI because today we saw a reversal. Initially, names such as NVO and Eli Lilly were blasting higher. This is the weight loss mania. But then they took a dive down, and the XBI closed down by about 1.5%. This could be the beginning of a reversal in NVO and Eli Lilly. So keep these two names in your radar. On to charts, and we begin with SPY, the S&P 500. What do we see here? We talked about 413.56 being a sticky resistance. And today we got a gap down, caught support from 410. But at the end of the day, we closed below the gap and certainly below 413.56. Forming what it looks like as a bear flag pattern. If it plays out and we lose 410 by the end of the week, then we have an advancement by the bears. The bears are advancing. They're not winning yet, but they're advancing. They're closing in. If we have a closing above 413.56, then the defense by the bulls is succeeding. That's all what they need to do. Close above 413.56. What are the odds saying right now? I mean, again, the SPY is only being held by a handful of names due to gamma squeezes. Well, the gamma squeezes have an expiration date. In Google, the expiration date is next week because they're playing it a little longer. So the market maker is supposed to be squeezed all the way till next week. So that could hold the SPY. But if these gamma squeezes come to an end tomorrow, in Amazon, in Microsoft, in Meta, and many other names, then the bears are going to win. We see the SPY at 410 or below. Here's the daily chart for the E-mini, the continuous contract. What do we see here? The volume is moving higher again. This is a bearish sign, not a bullish one. Still having a negative divergence on the RSI. Still negative momentum on the MACD indicator. So all of these are bearish signs. But then we'll look at the chart. It is still within range, 4100, 4180. So nothing happened. It's just the leading indicators, the RSI and the MACD, are telling you that the likelihood is for the break to be to the downside, for the chart to lose 4100. The Qs, 30 minutes chart, what do we see here? Unlike the SPY, we have a break here. Thank you to Google, of course. Now, Microsoft was down, but not by a lot. You see the polarity in Google versus Microsoft. If 1 week the AI mania is shifting to Google, money comes out of Microsoft and vice versa. But so long as the big caps, the majority of them hold, and you got one name being squeezed, the Qs can advance higher. And therefore, it is above 323.63. It is at highs, but I'm not identifying any new resistance. And the reason is I'm not really buying what's going on here. The breadth is really bad. The Nasdaq is only rallying based on one name, which means once that name is done squeezing, down we go. And I believe we're going to be back in this range sooner or later. I don't think this breakout is going to last. But technically speaking, from a charting perspective alone, you have to believe it. You look at the daily chart for the continuous contract for the Nasdaq, what do we see here? The break is confirmed today. Above 13,300, a closing at these levels right here would be a victory for the bulls. If they dive down below 13,300, then the battle goes on. But right now, the bulls are winning. The RSI is firming up. The volume is moving higher. That is the only bearish sign because you look at the MACD, we have a little bit of a crossing here showing positive momentum. So in the Qs, the bulls are in charge. The SPY, it appears that the bears are closing in. And as I showed you in last night's video, it appears that we have a market with two minds, all minding their own business. The bulls are happy chasing the big caps, the AI mania. 1 week it's Google, the other it's Microsoft, the next it's Amazon. And the bears are now adapting to that. They're no longer shorting big caps, Apple, Amazon, Nvidia. They gave up in doing that. The bears are now busy picking on the cyclicals, oil, regional banks, industrials, the metals now, the materials, and they're winning. So it appears that the bulls, the bears, everybody's busy in one corner, but at some point these two are going to collide. IWM, an hourly chart, what do we see here? It lost 174.22 and now it's forming a bear flag pattern. My expectations are more weakness for regional banks. Now the psychology becomes really important. Let's say the shorts are heading into a weekend and they say, oh, but the risk is to the upside. The FDIC, the Fed might do something over the weekend and they start covering, then the IWM moves higher. But my hunch is with the debt ceiling going on, the risk becomes to the downside this weekend. The dollar is telling the story here. This is a 4 hours chart for the Dixie. It closed above 102. It is telling you right here that there was panic. There was a little bit of fear about the outcome of debt ceiling negotiations. For now, the Dixie, if you look at the RSI, back into positive divergence, but you're not going to see the stock market getting rattled. I mean, you're seeing it already in certain corners. Metals were down big today. You cannot dismiss that at all by a little bit of a move in the dollar. What do you think will happen if the dollar moves all the way to 103 and captures that as support? That will rattle the stock market. It will certainly rattle gold. Today, gold moved down by a little bit, and therefore I'm keeping the bear flag pattern for now, although it's trading above 2,000. But if we lose 2,000 by tomorrow, we're going to see a lot of folks exiting the gold trade, and that could produce a flush down. Folks, I keep saying, why the rush? Why do you have to rush right now? You're not going to miss out anything. Gold is going to give you plenty of opportunities to get in. This is not a meme stock. It's not an AI mania. You're going to have plenty of opportunities to get in. SLV, look at this. Because if you get in the wrong time, you might get caught in one like this, a nasty one. SLV was down big today, flush down, and it could flush down even more. It could go down all the way to 21.57. So no rush, folks. Don't rush. Keep your cash. Keep accumulating more cash. If you're not sure where you're going to park the money, and your savings account is paying you less than 4%, your broker is paying less than 4%. I mean, interactive brokers are paying above 3.5%, I believe. Robinhood is paying over 4%. So you can park the cash right there. Or you can buy the 1 month bill like everybody's doing until the debt ceiling negotiation is over. When we look at oil, this is Brent oil, a daily chart. What do we see here? Facing the resistance of 77. For now, no need to panic. If the bulls manage to close above 77 by the end of the week, then we know that the demand for oil is still intact. But if this starts to move down to 72, 73 by tomorrow's closing, and it becomes clear that it's going to make a lower low, I think it's time to panic. But understand one thing. While we could see a panic in the stock market because of the debt ceiling negotiation, the likely outcome will be favorable for oil. Why do I say that? The likelihood is that Biden is the one who's going to capitulate, not McCarthy, which means the subsidies for oil are not going to be removed, and the tax credits, the generous tax credits for solar and EVs, those are going to be reduced. And that's all good for oil. So for now, there is a bullish case, even amidst the darkness of the debt ceiling negotiations. We'll look at the 2-year yield. What do we see here? Within range, frustrating, there is nothing we can do. The consolidation right here is not good for banks, folks. The fact that rates are consolidating right here should be terrifying. Once we got out of this consolidation range by a little bit in the month of February all the way to March, banks started to blow up. So we know that there is a threshold, and this threshold could be 4.6%. If the 2-year climbs back to that point, more banks will start to blow up again. And again, 4.6%, historically speaking, that is really low. This is how fragile this resilient economy really is. TLT, a daily chart, what do we see here? Catching a bid. Can you believe it? Can you trust it? Can you buy into it? The answer is not really. There's nothing to see here. You need to see a decisive break above 109.5, then call me. The VIX 4 hours chart, what do we see here? Back again at around 17, nothing new here. It is maintaining the positive divergence on the RSI. So for now, if you happen to be bullish VIX, you got a case. If the positive divergence is gone by tomorrow, you don't got a case anymore. Apple, the big kahuna, an hourly chart, what do we see here? Consolidating within range for the entirety of the week. There's nothing that happened in Apple at all. But it is forming a trend right here. It diverged a little bit higher above the trend, while forming a negative trend, a slightly negative trend on the RSI. We also have dividend day tomorrow. The chart, all in all, when you tie it all together, say that we might see a drop back all the way to the trend line. That would be at around 172.5, 173. That is still the sweet spot for the market maker. Tesla, an hourly chart. It looked really ugly. The bear flag is going to play out, and we'll see a break below 176.5 by tomorrow. Then comes Elon Musk with the news from Twitter. The stock caught a bid by the end of the day. Is it going to last? Is it not going to last? There is a probability that we could see a short squeeze happening in Tesla tomorrow. But pay attention now. If it doesn't happen, if Tesla goes down anyways, or stays flattish, then all of these squeezes that we've seen recently in Amazon, in Google, in Microsoft, even in Apple, they were all led by the institutionals, by the professionals. You know why? Because the professionals are not going to look at Tesla and say, oh my God, Elon Musk is back. This is what we've been waiting for to buy Tesla. The problem with the stock is fundamental in nature. It's not related to Elon. On the other hand, if Tesla catches a short squeeze, maybe closes the gap at 180, then understand that the retail crowd is behind this. The retail crowd is the one that would do the job and close the gap and stampede to buy Tesla. But if they don't show up, then I would view this as a red flag. That the retail mom and pops are already in, if they want it to be in, and the ones staying on the sidelines, they say, I'm not interested here. I'm happy to be on the sidelines. Which means all of these games we've been seeing lately, they've been led by the institutionals, not the retail mom and pops. We'll look at Amazon, a 4 hours chart. What do we see here? We talked about the cheat. The stock was supposed to go down 101.15. Instead, we got the cheat, the gamma squeeze. It got us above 109.26. It got us all the way to the upper range of the channel, and now it's facing overbought conditions. And it is facing the target from the gamma squeeze, 112. If you're playing lotto tickets and you read my midday update, the conclusion that you should have gotten is, okay, so I'm going to buy the 110 puts on Amazon with the expiration date of tomorrow. That's my lotto ticket, because Amazon will move down to 111, 110.5. That will be enough to flip the trade into a profit. And then we got Meta. We have an update for Meta. You see, it caught a bid today, but it closed below support. And if this continues, the likelihood is that Meta is going to lose 230. And if it does lose 230, a lot of selling will incur. And I'll tell you why. The holders, they've been holding since post-earnings, and nothing been happening in Meta. But they're happy to see it above 230. That's good enough. A lot of folks bought Meta after earnings, and now they're sitting on either flattish or losses. 230 is the line in the sand. If the stock starts to trade below 230, we got a problem, because the holders who bought recently, they're going to start to panic and get out and minimize their losses. The holders before earnings will start to book profits, and we could see a flush down in Meta. So watch this chart. Too early to say that that's going to happen, but if 230 is violated, you got to go short. NVIDIA, an hourly chart, what do we see here? Gave it another shot at 289.46, didn't happen. And now we have yet another bear flag consolidation pattern. Is it definitive? The answer is not quite, because if you look at it all in all, we have consolidation below 289.46. As if the chart is inviting buyers, saying, hey, right now I don't have the energy to do the job. But if there is anybody waiting in the sidelines interested in buying NVIDIA, I'm ready to go. I'm ready to go to 300. If the squeezers spot this out, they're done with Google, they're done with Amazon, they could migrate to NVIDIA and push it all the way to 300. So there is a risk to the upside still. But if this chart doesn't find buyers right here, and it starts to dive below 280, then we'll know for sure that 289.46 was the top. Tulips, Bitcoin, what do we have here? Not looking good here, folks. It is really sensitive to the US dollar. The dollar is moving higher, Bitcoin going down, but it did not break support yet. Keyword yet. 26,555. But it could happen overnight. It could happen in tomorrow's session. If it does happen, you have to look at Coinbase, COIN, a daily chart. Now, the company's in trouble with the Pepe crowd, but that's another conversation. I don't speak monkey, so I'm not going to get into that. To each his own, though. If you're making money on Pepe, good for you. But the question becomes, if Bitcoin goes down, the chart already violated 53.66. Then came the bump from post-earnings. But now with Bitcoin going down, it is rational to say that COIN will have to go down and retest 53.66 as support. So you can have a put options trade all the way to 50. You can buy next week's puts or June puts. It doesn't matter what contract you pick. The more time you give yourself, the more you're going to pay, but the more room for maneuver you're going to have in case you're wrong. In any case, I believe that the retest is going to happen, and that would be a good trade. Maybe we go down all the way to closing the gap. And with that, folks, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the import price index. This is the last piece of the puzzle when it comes to inflation. Then we have the preliminary reading for the consumer sentiment. And of course, we have a tag team between St. Louis Fed President Bullard and Governor Jefferson. What are they going to say now that we got the readings of the CPI and the PPI? My hunch is Bullard would say it's time to pause. Will the market be excited that Bullard is now saying it's time to pause? We'll see, because the market right now is preoccupied about the recession risk and the debt ceiling risk. Until then, folks, this is all I got for you for now. Once again, thank you for your support, thank you for listening, thank you for watching, and I will talk to you again tomorrow. Take care.
Do everyone a favor. Get out the treasure map and start digging. You got a week.